All right, everyone, it is 7 p.m., so let's get started. Welcome, everyone, to the 15th episode in our second ongoing webinar series for federal employees. My name is Quinn Ackerman, and I'm one of the co-founders here at Parco, as well as our Director of Marketing. I'm joined this evening by my colleagues, John Mantia and Daniel Hampel. They will be manning the question and answer section of this long-term care webinar this evening. So for those of you who've been on before, this part's always a repeat. But for those of you who are new, it's great to see some new faces on tonight. And so we just want to tell you a little bit about who we are and what it is we're doing. So we're Parco, which stands for Pension Americans Retirement Company. And we're a financial services firm that's exclusively focused on retirement planning for federal employees and retirees. So our ultimate goal is to save you time by making the complex simple. Strategizing these federal benefits on your own and figuring out how they fit into your overall financial plans is time consuming and complicated. So we're experts. We're experts on your federal systems. We're experts on finances and how all of it plays together. And that's what we're here to do. Whether you're just starting out and you're new in your career, or you're near retirement and you need help with paperwork, or you're in retirement trying to figure out how to strategize like things like RMDs, or you're everywhere in between, we're here to help with all of it. So you may have recently seen us featured in some of the below publications. We're really working on building a name for ourselves, augmenting our brand. So you've probably seen us in some of these publications recently. A few ground rules before we get started. For those of you who are new, if you have unique questions that pertain to your individual situation, you can ask them in the chat window. We're going to try to cover as much as we can and answer as many questions as we can tonight. So do know that chat window is there if you want to use it. Also, be on the lookout for a survey email afterwards. This is how we collect feedback, not only on how we're doing, we want to improve these presentations to make them as useful as possible for you guys, but also to get feedback on what you want to see covered in the future. If you're not seeing something done, or you want to some insight from people that exclusively work with feds and how we view these things, let us know. This presentation tonight is actually inspired by a few clients who were helping strategize their long-term care needs right now as we speak. So tonight's presentation, long-term care, evaluating your options. This is a very, very huge topic right now. Not that it hasn't always been big, but especially with COVID and everything that's happened in the past year, we're seeing a lot of people come forward asking us for more help on how they should approach this problem with increasing concerns of making sure they're being taken care of well into their elder years. People are living longer than ever before. So we figured it was about time to delve into this. So just know this topic is super dense. We're going to hit as many main points as we can to give you guys a good overview. But when it comes to your unique situation, there's no way that we're going to have answers to all of these questions just based off of this presentation. So reach out to us. This is what we help people with every day. Our goal here is to keep this presentation about 30 minutes to keep it digestible. So that's our plan for this evening. First, we're going to just talk a little bit about what long-term care exactly is and how it's going to work, what you should expect as you're going through it. Two, we're going to talk about some factors that are going to impact the cost of your long-term care premiums. No matter which long-term care avenue you go down, there are definitely things that are going to impact how much you're paying for it ahead of time. Third, we're going to talk about the different types of long-term care insurance. There's a type of long-term care insurance that everyone has thought of and that everyone typically thinks of, but there's actually some more creative solutions out there today for those of you with those concerns. And then finally, we're going to do a brief cost analysis. Let's put some numbers to this and see what kind of costs you guys will actually be facing when it comes to long-term care. So getting started. What long-term care is. Long-term care is designed to help you with your health needs or maybe your personal needs once you get to the point when you can no longer perform certain daily activities on your own. Now, There are 6 activities of daily living that long-term care generally specifies. And to be able to turn on any long-term care that you've been paying for, you're going to have a doctor certify that you can no longer meet at least 2 out of these 6 activities of daily living. Eating, bathing, getting dressed on your own, toileting, transferring, which is simply just getting up and out of a chair, moving from one place to another, incontinence. So once a practitioner has officially certified that you cannot do at least 2 of these on your own, that's when your long-term care benefits will essentially turn on. Now, there are one of the very common misconceptions is who exactly is going to cover this long-term care. And a few big things to know. Things that don't, your healthcare, your FEHB. There's no healthcare plan out there that is going to have a long-term care component. This is different from hospice. So I know it can get a little confusing, but long-term care does not include hospice here. Medicare, your traditional types of Medicare, these are also not going to include any long-term care. Again, hospice is an entirely different story. What will cover long-term care? Some VA disability programs will cover long-term care. There's somewhat of a ranking system. So if you have a VA disability, they tend to filter it out and assign priorities to those with higher disability levels. You can also get long-term care assistance through Medicaid. So not Medicare, but Medicaid. And then long-term care insurance, whether you're insuring yourself and you're paying for it out of pocket, or you've opted into some type of optional long-term care, these are going to pay out long-term care benefits. So, a thing to know, let's say you've hit your 2 out of 6 activities of daily living. You need help with at least 2 of these on a permanent basis, and the doctor has given you the green light. After you qualify, your benefits do not start right away. You are going to have to undergo a waiting period. Typically, this is 90 days. That's the average for most long-term care policies. You can actually adjust this number, make it less, make it more if you want. Obviously, the longer you wait, the cheaper your premiums are going to be. The shorter you wait, it's going to bump up the price. So you've qualified, you've gone through your waiting period. Now at the end, with the majority of these long-term care policies, you will be reimbursed for costs moving forward. So another kind of confusing thing about long-term care is you're not getting paid cash out front. What's going to happen is you're going to have to submit reimbursement requests, and they will cover those costs. So you are still paying a little bit out of pocket, at least up front. Now, there's 2 broad categories of long-term care, and there's a ton of different subcategories within them. A really good way to think about it is with these 2 broad categories. You've got your home-based long-term care services. These are things that are going to take place within your home. Then you've got your facility-based long-term care services. These are going to be when you're actually staying within a facility. Assisted living, nursing homes, broadened care homes versus being at home. Maybe you've got some home health care. Maybe you've got someone helping you with some homemaker services, or even some adult daycare transferring to and from your home. Those are going to fall under the home health care categories. So long-term care, why do people have insurance against it? Well, they're wanting to insure against the rising costs of healthcare and elderly care. This has been a trend that's been going on for a while now. It's certainly not stopping, and it's all heading in the same direction. It's getting more expensive. So we wanted to show you a few statistics here. Let's say you need to stay in a private nursing home. This is typically when you're getting 24-hour around-the-clock care. It's not just assistance with living, but it's actually medical attention as well. That's going to be your most expensive. The average is a little bit under $7,700 a month. If you don't want to be in a private room, it'll be a little bit less, still close to $7,000 a month though. For those of you who think you're going to need care that's more along the line of assisted living, where you're not getting medical attention per se, just getting some assistance with your daily tasks, it's cheaper, but it's not cheap. And then as you can see here, there's definitely a big dip between facility services and home health care. So home health care is most often going to be more affordable. Of course, this is naturally all relative, but whether you're getting help from a health aide, help with some homemaker services, or even being transported to an adult daycare center during the day, those tend to be less expensive. Now, we want to show you this graph for average long-term care costs in 2020. So for those people that had to go into a nursing home, the cost each year was roughly $100,000. And sure, it definitely decreases a bit given the type of care that you are getting. But the point here remains the same. It's extremely expensive, and I'm sure many of you have all been personally affected. This is a lot more than a number. Many of you have had parents who have to go into long-term care, and maybe you're footing some of that bill. Or you've got a serious history of certain conditions where this is something that is in your future, and you're worried about the burden that numbers like this are going to place on your families. So this is a lot more than just a number, and it's numbers like these that cause people to seek out long-term care to ensure against the rising costs that we're seeing. So now that we've got kind of an overview of long-term care out of the way, let's talk about some factors that are going to increase how much you're paying for these premiums. Starting first with the personal ones. These ones are pretty straightforward. Age. The younger you are and the earlier you start paying for long-term care insurance, the cheaper your premiums are going to be. Another big thing here, and this gets a lot of people, is the status of your health when you sign up for the insurance. So you will have to pass underwriting requirements. People do get declined, and then premiums are also tiered based on the status of your health if you do get accepted. So your health status is going to play a role here. Another one, many people don't know about this one, is actually your marital status. So if you're married or you have a domestic live-in partner, you get a discount. And then gender often plays a role. So on average, men are going to pay less in premiums than women because insurance companies know that men on average live less than women do. They're anticipating having to pay out benefits to women for longer. So they are going to increase your premiums accordingly. Now, the type of policy you get and the levers that you pull within that policy are also going to impact your premium. So I like to think about a lot of these as levers that you can adjust to try to get the cost into a range that works for you. So the first isn't, I guess, so much of a lever as just the type of policy. We're going to get into this later, but the things that you're going to be considering here, use or lose policies versus use or pass on policies. And we'll get into that in a bit. Now, here's a lever. Your benefit, the amount of benefit you receive each month. The more benefit you want to receive, the more you're going to pay for it. Same thing with the term here. Most long-term care policies have terms that you can receive benefits for. Most people are familiar with the 5-year term. There's some 2-year, 3-year, 5-year. I've seen 6-year. The amount of time that you are hoping to receive benefits or that you're going to insure yourself for, that's going to increase your premium as well. Then this is becoming increasingly popular with many, many long-term care policies or inflation riders, right? We know healthcare costs and elderly care costs are rising significantly. And so they've offered these inflation riders. So the benefit you get will actually be increased to adjust for inflation over time, but you are going to pay for that. And then the final thing here is the waiting period. So the longer you wait before the waiting period, after you qualify by meeting 2 out of the 6 activities of daily living, you undergo that waiting period. The longer you make that waiting period until your benefits turn on, the cheaper your policy is going to be. And just another layer to complicate matters, as if this wasn't already, dense enough. All premiums and plans and offerings that are going to be available to you are very heavily dependent on where you live. State regulations play a role. Average health care and elderly care costs in any given state play a role. So do know this is going to be based on your zip code. So if you've got friends out of state, family out of state, they are not going to necessarily be looking at the same prices as you are. So we've got the basis of what long-term care is and what's going to play a role and how much it costs. Let's talk about the actual different types of long-term care policies and benefits that you can receive. We've divided this up into three main types of coverage. The first one, self-insurance. Pretty straightforward, but we'll get to the pros and cons of that in a second. The second is this use or lose it coverage. We'll get into what that is in a second. I'll keep both of these a surprise. And then that third one is the use it or pass it coverage. So let's analyze self-insuring yourself for a second. Pros, you have no monthly or annual premiums that you are going to have to budget yourself for. This is no small thing. In retirement, we know that you're living on a fixed income. Federal retirees are actually relatively wealthy compared to most Americans because you guys get this pension on top of any supplement and or Social Security benefit. So actually, most of you are in better shape to take on a long-term care policy than your average American, but as we're going to get to, the costs are not cheap. So if you cannot afford to have this sort of premium in your monthly budget, self-insuring may be the way to go. Another pro is that you haven't paid anything into it in the event that you don't need it. This is a big problem some people have with the, as you guessed it, use it or lose it long-term care insurance. You can pay into something and never receive a benefit if you never have to go into long-term care. Then you've paid into something you never receive. So if you self-insure, you are avoiding this problem. A con is pretty straightforward, the biggest one. You can quickly drain your assets if you do end up needing long-term care. Referring to that graph that a lot of us were looking earlier, if you end up needing to go into a skilled nursing home, the average cost of that in 2020 was over $100,000. So this can very quickly drain the assets that you do have if in fact you fall into a boat like this. And because of that, another con, you do run the risk of placing physical and or financial burden on your family members. Many of you may have experienced this, and that's typically the natural route. If someone can't afford for long-term care, either in a facility or professionally, they turn to their family members for that. So those are some of the cons that you will be facing if you decide to go the self-insurance route. Now, those use or lose policies. These are the traditional types of long-term care insurance, or even just insurance. It's kind of like term insurance that you think of. What you're going to do is you're going to pay premiums and you're going to receive a benefit if you meet the ADL requirement. This is going to include both your federal long-term care option and the private insurance option. Pros here. So it's still expensive, but it is actually the highest benefit you will receive per dollar that you paid into it, assuming that you do collect it. And of course, the pro here is that it will help protect you against the rising cost of elderly care if and when you do need it. Con, you're still going to have to pass medical underwriting to be insured. This is big. Another con, premiums can increase over time. This is something that's also scary with long-term care, use it or lose it policies. Your premiums are not fixed. They can and most likely will increase the older you get. So not only do you have to be able to afford the premiums today, you will have to be able to afford any potential hikes in premium down the line. Con also has a waiting period before reimbursement. Whatever that length of time is that you choose, you will be paying completely out of pocket until your long-term care benefit kicks in. Another con with use or lose policies, because it's the most affordable option, they are going to have a maximum amount of time that you can use this benefit, and they're going to have a maximum amount that you can collect. Of course, the longer that term is and the longer you make that, or the higher you make that max benefit, the more expensive it's going to be. So this can be scary for some people. If you anticipate being in long-term care for a long time, this benefit can run out. And then again, one of the biggest cons of all, if you lose it, if you never use it, you lose it. There's no refunds. You can't say, oh, I want to get paid these premiums back. I can tell I'm not going to need it. There's no way for you to pass it on to any sort of beneficiary. It's something that's gone when you pay for it. So this is certainly going this route is not a decision to take lightly for sure. Let's just touch on the federal long-term care option there for a second. FLTCIP, that stands for Federal Long-Term Care Insurance Program, and it's underwritten by John Hancock Life Insurance Company. Just as FEGLI, your life insurance, is underwritten by MetLife, your long-term care has a private underwriter as well, and it's John Hancock. So this is going to be available to any full-time federal employees, federal annuitants, survivors, spouses. that sort of thing. The thing here is that your premium, again, is not fixed. It's a use it or lose it policy, so it can go up over time. The one benefit to this one, though, is that it's going to be subject to group increases over time. So while other private ones can be subject to individual increases over time, they can judge based off of other characteristics that they should increase your premiums. This one's going to be based on the entire group. So it does and can happen. But it's a group increase, and that increase has to be approved by OPM. So that's a little bit assuring there. Now, the pricing schedule to the federal long-term care is actually based solely on your age and not your gender. So this is one of the times where it could be a better deal for women. We know you guys face higher long-term care premiums because you tend to live longer. So you female feds out there, if you're interested in long-term care, or excuse me, use it or lose it long-term care, you'll certainly want to get some quotes here and compare it to private and see how those play out. On the flip side, though, this is kind of a catch-22. You actually don't get any discounts for good health. So you're still undergoing medical underwriting. You can still be denied from this program. But let's say you're in really good health. You don't get any sort of additional benefit for that. If you pass under medical underwriting, you pass. It's going to be based on your age. So as you can see here, there are some certain little fine tunings that may make private insurance better, or it may make the federal version better. You'll definitely want to get quotes run on both federal and private options to see which one you fall under. Now let's talk about the next type of of long-term care insurance. You've got your use or pass policies. Now, what does this mean? Well, the idea to a use or pass policy is that you can pass on a death benefit in the event that you do not use long-term care. Said another way, even if you did use that long-term care, if you don't use all of the death benefit, you can still pass that on to beneficiaries. The two main types of ways that we see this are with life insurance that have long-term care riders, or fixed index annuities that have a long-term care benefit. Now, both of these kind of play out in different ways, so we'll view them separately. But the common theme is here, you're not paying into something without seeing it on the other side. Maybe it won't be you, but in the event that you don't need long-term care, this premium isn't going to nothing. So let's start with the life insurance plus long-term care policies. Big pro, like we just talked about, if you don't use it or any of it is left, the death benefit will pay to your heirs. And on top of that, it's life insurance. So that benefit is tax-free. Tax-free inheritance is a really, really powerful legacy planning tool. So that is a very strong benefit. Again, this is insurance, so it's helping you protect yourself against the rising cost of elderly care. And a huge, huge pro to the life insurance one is that it's going to pay you for a lifetime. So there's no cap to the length of time you can receive care or the amount that you can receive from it. So here's how it works. You elect this life insurance policy with the long-term care rider. You pay premiums into it every month. Let's say you meet the 2 out of 6 ADL requirements. You've gone through your waiting period and your benefits turned on. And now you start getting reimbursements for that care. First, those reimbursements are going to draw down your death benefit. So whatever your death benefit is, that's what they're going to pay out to you first. And they're going to keep drawing from your death benefit until it reaches 0. If you keep living past that time, they're going to continue to pay you for as long as you live. So that's a really, really huge benefit with the life insurance plus long-term care rider. Another pro, premiums are fixed. What you pay is what you lock in, and you will pay that same amount forever. Con, it's still going to require medical underwriting, so you can still get denied. But again, if you're on the healthier side, you can actually get a preferred sort of rate. That's something the federal long-term care doesn't offer. Con, you're still going to have that waiting period before the reimbursement begins. That's one of the levers you can pull to either increase or decrease your premiums. And another big con to the life insurance plus long-term care rider, because you're getting all these benefits, they are even more expensive than traditional long-term care policies, and they're a lot more expensive. Now let's talk about the fixed index annuity plus long-term care benefit. Massive, massive pro to this. There are no premiums. When you're using the fixed index annuity here, you're using it as an investment vehicle. Fixed index annuities live within, if they're traditional funds, a traditional IRA. And typically, you tend to move a portion of your retirement funds that you'd like to protect from loss. We know fixed index annuities are extremely safe. Because you've done this and because you're housing your investments within this fixed index annuity, you are not paying any premiums. So the long-term care benefit that you get when it turns on is free. That is ginormous, especially for those of you, and as all retirees will be on a fixed income, having to account for how many expenses they can handle each month. Another pro, the reason we chose a fixed index annuity here as opposed to the other types of annuities is that fixed index annuities allow you to leave any remaining balance to beneficiaries. Common misconception, you are not surrendering your balance here. Those tend to be more popular with variable annuities. So with fixed index annuities, anything you don't draw from is going to pay out to your beneficiaries. Another huge plus, and that's what puts it in the use it or pass it on long-term care category. Another huge pro to going down this road is that the benefit, the long-term care benefit, pays out monthly instead of as reimbursements. What do we mean by that? Well, you get cash. You're not submitting all of these reimbursement requests and receipts for the care that you've received. You've got a set benefit and you just receive it in cash every single month. And another big pro, no medical underwriting. So they are not going to screen you to see if you can actually be underwritten for this long-term care. You are automatically approved. So very, very big pros. Cons. When you're looking at fixed index annuities as an investment vehicle, particularly ones with long-term care riders, they oftentimes have lower potential growth rates compared to other FIAs without long-term care benefits. A lot of the times where you see FIAs as good G fund replacements, people are looking for better growth than the G fund. If you go that road with an FIA that doesn't have a long-term care benefit, your potential for growth is probably a lot higher. Your fixed index annuity with long-term care rider is going to rein that potential growth in a bit because they're going to give you this long-term care benefit. Makes sense. Another con is that there are a lot of products and carriers out there, and they are not all the same. So you're going to want to make sure you're working with one of the good ones. Some are definitely better than others, and that's certainly something we help our clients with as well. So we've talked about the different types of long-term care routes you can go, what it is, and a lot of the factors that are going to affect your premiums. Now let's look at an actual cost example. So again, it's going to vary on zip code. It's going to vary on health. It's going to vary on if you're married or not. It's going to vary on the fact that there's going to be time that's gone by the time when we ran this quote and when you run your quote. Healthcare costs are rising every day. So let me just caveat this with costs are going to vary. But let's take a look at an example here. We're going to use a traditional long-term care option. Think of this as either your federal long-term care or private alternative. Then let's compare the life insurance with long-term care feature. We want to compare apples to apples. So we're going to go for a $5,000 a month benefit that equates to $168 a day for both of them. We've elected the inflation option. With the traditional long-term care, that takes effect immediately. Of course, you're paying for it both here in both of these, but with the traditional long-term care, basically that term insurance takes effect immediately. With the life insurance, it doesn't take effect immediately. Why is that? Well, with the life insurance, we know you're first draining your death benefit, so they're not going to apply any sort of inflation to your death benefit while you're still draining it. Let's say you live past it though, and you are continuing to collect lifetime payments, they'll apply the inflation rider then. So we've got an inflation rider on both of these. We also have the waiting period is 90 days for both of them. Of course, naturally, here's one of the difference between your traditional long-term care insurance and your life insurance. Traditional long-term care insurance has a term maximum. You can only collect it for a certain amount of years and then you're done. In this example, we've elected 6 years, tends to be close to the most you can get. With the life insurance, it is a lifetime benefit. Once you drain your death benefit, you keep getting paid until you die. So that's a key difference there as well. And then on top of that, cost guarantees. So we know with your traditional long-term care insurance, your costs are subject to change. In fact, they are most likely going to increase over time. With your life insurance and long-term care feature, Your cost is fixed. So you're never going to pay more than you started with. Hold on, please excuse me. I have a very barking dog and I need to tell him to shush real quick. Sorry about that, guys. Okay. Just to build up the suspense, we've got all of these things. So what do we think the price difference between the two of them is? And let me just make sure I've caveated this. This is actually a share to care benefit. So this is on a married couple, on both of them. Age 60, living in Maryland, they've got a preferred rate, non-smoker. The difference, it's huge. So the traditional long-term care, it's going to cost you a little under $600 a month for this exact benefit. The life insurance and long-term care feature, it's going to cost you close to $2,230 a month. And this cost difference is huge, but it also makes sense, right? You're paying for a lot more with this life insurance one. You're guaranteeing a benefit, whether it's to you or it's to your beneficiaries. You're also making sure the long-term care is there forever. So they are going to make you pay more for that. As opposed to this traditional long-term care, it is more affordable, relatively speaking. It's still expensive, but you are running the risk that you never actually get to use this, and it'll be a cost that you pay into that you never get. And it's costs like these and why we often, when we're helping our clients figure out what long-term care makes sense, if they are fee sensitive and their fixed incomes don't allow for either a cost like this, we at least look into that fixed annuity option. Does that make sense for your portfolio, your goals? Do you have a long-term care concern? And if so, what's the most cost-effective way to get there? And a lot of times that's it. But again, the right one for you, you can never make a blanket statement that one's always better for the other than the other. You know, there's a lot of factors that are going to play into which long-term care route you should take. Things to ask yourself: do you have assets and a good income to be able to afford these premiums? 2, do you have long-term care concerns at all? If you don't, well, then certainly don't even worry about going down any of this stuff. But if you are and you're worried about draining your assets by having to pay out of pocket, this is something you're going to want to look into. And a third question, can you afford, I think I might have already said this, the premiums and potential hikes until care is needed? That's no small thing. If you're paying these premiums for 20, 30 years, it's a lot of money. And then 4th, are you concerned about burdening your family? You know, are you facing that yourself on the other side of it? Are you wanting to make sure that that doesn't happen again? You know, something to talk about. And then 5, and this is a really big one, you know, do you want to be able to choose the place you receive care? That's a big flexibility that long-term care insurance often provides. So if your answers to these questions are leading you to believe that long-term care is something that you need, reach out to us. We'll help you figure out whether it's the term insurance, the use it or lose it, that makes the most sense, whether you have huge legacy goals and maybe the life insurance one makes the most sense, or maybe the fixed index annuity one makes the most sense. Again, no one size fits all answer to anybody, to everybody. It's really going to be dependent on you. And we're here to help with that. So here's our works cited for this evening. Please let us know, anyone, if you want it. We're on kind of an insurance kick right now. So our next big topic that's starting next week is going to be FEGLI and insurance strategies. How much is too much? How much life insurance do you need? And when have you gone overboard? And what types of FEGLI and other types of life insurance are more affordable than others? We're going to talk about retiring before 60. Can it be done? And some of these are going to be subject to change. Early retirement. And then just a friendly reminder, on the last Sunday of every single month, we do a retirement paperwork webinar. Our colleague Daniel Hampel, 6 p.m. on Eastern on Sundays, runs through how to fill out the FERS application for immediate retirement. So if you're interested in signing up for that, let us know. We're going to stick around to answer your guys' questions in the chat window. We applaud everyone for being on this evening. Hope you found this information useful, and we'll see you next week.